Hello and welcome to the first full week of trading in September. I'm Nick Quinn and this is the weekly forecast from the team at forexsignals.com. Liquidity providers are back at their desks after the summer holidays and it is the best time of year to be in the markets. This week features a 5-star economic calendar headlined by the US CPI data for August. By Friday's bell, we'll have a much clearer idea on the state of the US economy and what to expect from the Federal Reserve meeting on September the 21st. So let's have a quick look round at some of the key markets that will be in focus this week. So let's have a quick scan around the markets. For Monday, all day today, the pound is going to be the focus. We've had GDP figures out already for the UK economy, and it has been a slightly better than expected picture. That puts the bulls firmly in control. You can see these pandemic lows of around about the 114s up to 115s area have held the market and stopped the downtrend in its tracks, at least for now. But I don't think personally that we are out of the woods just yet on the pound. We are now just sitting on, this is a 15-minute chart, we are sitting very much just under resistance from around about the early 117s up to the mid 118s area. Anywhere in that area is we could potentially run into some levels of resistance. So bear that in mind as we go from Monday into Tuesday into Wednesday. That area from 117 up to 118.50 could pose some problems for the bulls. Looking at Tuesday's price action, we have headline CPI and also core CPI out of the US, the biggest inflation reading that we can expect of the month, and it's the apex of the week for me. Very, very, very critical for the Federal Reserve to be looking exactly how they're going to be tackling interest rates, and this is going to be a very important number that they're going to be watching, and we should all watch it too. There's two types here, headline inflation and also core CPI. The difference between the two is basically you remove food and energy prices from core CPI. That reduces the volatility of the reading itself, the theory being that it gives us a more accurate picture. We are expecting on the year-on-year core CPI slightly worse than expected, 6.1 over the previous 5.9. The headline inflation CPI is expected to come in slightly better year-on-year, 8.1 over the previous 8.5, which is a mixed picture in itself, but you know, I cannot see at the moment how the Federal Reserve is going to change its course, and even if we get a slightly better print on CPI, I can't see how that's going to change the dynamics of how they are talking incredibly hawkish at the moment since Jackson Hole. So if we look at the S&P 500, this is the E-mini futures contract. You can see we're just running into that resistance area here on the daily chart. You know, we did end the week last week with a very bullish tone for US equities across the board, but I can't see how one better CPI print is going to change the course at the moment. So for me, I am bearish on the stock market still as a whole, and I'll be looking for somewhere in this resistance area for potentially for the bulls to run out of steam and the bears to take control. So that comes in, that roughly that range comes in from around about 41.50s down to 41.10s. Moving on to Wednesday, yet more inflation. This time out of London for the UK CPI report. We are expecting 10.2 on the previous 10.1, and that's definitely going to be putting the pound in focus for Wednesday. Moving on into the rest of the session on Wednesday, it will be focused on PPI numbers out of the United States, and they are projected to come in at 0.1%, an improvement on July's 0.5%. Equities again very much in focus, but this time we could just reference the Nasdaq itself, just so you know where those resistance levels are. Moving into that area now, we're just sitting under there, around about the 12,800 mark for the Nasdaq. Anywhere north of there, up to 13,000, expect some kind of resistance for prices to move higher. And finally, that takes us to Friday, when it's almost fitting that we end with inflation. We started the week with inflation, we will finish with inflation as well. This time, it's from the Eurozone itself, where we are expecting an uptick in month-on-month inflation for August, 0.5 over the previous 0.1. I can very much see that happening. The situation in Europe is far worse than it is in the US or in other countries as well. So that brings the euro into focus. Now, be very, very careful with the euro. It looks and it feels bullish, but, you know, for me, commercial hedgers have not changed their mind. They are still on the side of looking for for more downside in the euro. We have secured this this potential zone here from around about 1.01 up to 1.0250. We have sort of like just dropped off it today, but today of course is Monday, and it depends how the price action is going to develop over the next few days. But I will be looking for rotation lower, just taking it down to the hourly. It definitely, there is some potential upside to 102.50s, that kind of area, but I'm not expecting any major bullish moves out of the euro this week. And don't forget, if you want to read the report in full for yourself, you can access it simply by scrolling to the bottom of our webpage, and you can read the entire report just under their Forex forecast. So make no mistake, the coming 5 days in markets are critically important, and we've only just touched on a few key events. Other market drivers are expected out for New Zealand, Australia, Canada and Japan. Even the world of agriculture will be hyperactive on the release of Monday's World Agricultural Supply and Demand Estimates report. So if you like the action, you are going to love the first full trading week of September. From US inflation to the Bank of England, we've got you covered. See you next week.